No matter what segment of the beef business you're in, the 2020 market has been a roller coaster unlike what anyone could have predicted the last quarter of 2019. From cattle feeders to meat cases, the aftershock of COVID-19 has been felt at every segment. Our next speaker, Dr. Dustin Aherin, joins us today to offer some big picture perspective about the far-reaching impacts of cattle procurement, processing, and merchandising in a world adjusting to a pandemic. Aherin joined the Rabo Agri-Finance team in February of 2020 as a vice president and Rabo Research animal protein analyst. His diverse background in the cattle business, from the seed stock and commercial cow-calf level to professional cattle feeding, provides a well-rounded approach to the economics we're going to take a look at today. Dustin, we're looking forward to hearing about the 2020 hindsight you have to share with us today.
Thank you, Kara. It's a pleasure to be here with everyone this afternoon. So, as the biggest, most acute challenges to the beef industry in regard to COVID-19 have started to recede, we have fed cattle backlogs diminishing. We've seen a pretty respectable rebound in cattle prices. The conversation often turns to what's next, what's going to happen after we get through the disease, what does the beef industry in a post-COVID world look like? But before we get too far down the path of what's next, I think it's helpful to look back and really try to understand why events played out the way they did. And in a scenario where things were moving really fast, markets were extremely volatile, I think it helps to take a step back and think, really how do cattle become beef? When the production system is humming along smoothly, I think it's easy for all of us to take that efficiency for granted and forget that cattle really aren't beef. They are a single input into the production system that requires a number of other major inputs, some of which would be human labor, whether that's physical or mental labor. There's physical capital, such as facilities, and then technology advancements. We've had some pretty good examples of throwing that equation, that input equation, out of balance in the last year between the Tyson-Holcomb fire, which primarily impacted physical capital facilities, whereas the COVID-19 scenario impacted human health, the ability to run plants, trying to incorporate new technology in places where we hadn't used it before. It really threw that equation out of balance. And now this equation is never truly in balance. It's always trying to be in balance, but it's this always seeking but never finding nature that creates cattle cycles, that creates the cycles that we see in a lot of different commodities, whether that's oil or cattle. And when this system is out of balance, it communicates that through prices, whether that's cattle prices, wages, or capital investments. And I'm sure all of us felt the sting of that communication earlier this year with the collapse in prices. So an example of these cycles, U.S. beef cow inventories. We often see an overexpansion and overcontraction in cow numbers. Another good example of this cyclical nature is fed supplies relative to fed cattle prices. And this really touches on the communication aspect as well, what communication prices really serve. So as you can see, they tend to move in opposite directions. That's no surprise to anybody. Think about 2013, 14, 15, we had falling fed cattle supplies and really, quickly increasing fed cattle prices. And now in this chart, I've adjusted for inflation and indexed these prices and supplies so that way they're more comparable across years. But if you look at what happened here in 2020 with an extreme increase in fed cattle supplies, given the backlog, the collapse in prices, really wasn't unexpected. It's also important to note that we see these cycles within years, not just across years. Different quarters, different months, based on the production cycle, we see different levels of cattle availability and different price levels. The recent events, both COVID-19, the Holcomb plant fire, really highlighted the industry's focus on packing capacity. But this is really something that's been developing over many years. This chart gets a little bit noisy, but if you just focus on the orange line and the dashed blue line, that's monthly fed slaughter capacity versus actual monthly fed slaughter. And now these are estimates, and it's difficult to really keep up with the operational capacity at these plants. But really notice how over the last 20 years, the slack in the system has gotten tighter and tighter. We have more fed cattle relative to capacity, particularly in the last 4 to 5 years. So now to switch gears a little bit after talking about kind of the general structure of the industry, let's switch to futures. So there's something called the CBOE Volatility Index, which is a way to assess forward-looking volatility in the S&P 500. And when this index gets elevated, for instance, over 30, we see a really tight correlation between the S&P 500 and live cattle futures. And that held true in this spring as well. And so really, why does that happen? When the financial environment really becomes a risk-off environment, investors want to pull money out of the market, leave it in cash, put it in U.S. treasuries, maybe even put it in gold, but essentially flee to safe assets. And when we think about who takes the other side of a live cattle contract when we're placing a hedge, it's often managed money. Maybe that's in a passive index fund where it's being used to diversify a portfolio. Maybe it's a hedge against inflation, which commodities are often used for, or maybe it's a speculator. But in either situation, there has to be someone willing to take that long position. And in such a high risk environment, it's really difficult to motivate that side of the market. So this index is often called the fear gauge. And when we look at how the correlation actually played out in the early days of COVID-19, when there was a lot of fear in the marketplace, we see that the correlation was extremely high between the S&P 500 and the nearby live cattle contract, which would have been the April contract for most of this time period. As we extended into April, we started to see plant disruptions kind of throw off that trend, and then federal stimulus and government relief packages being put into the market, the Federal Reserve stepping in, really helping the S&P 500. But while these initial fears were in place, it's not surprising that there was a tight correlation between live cattle futures and the S&P 500. Of course, another big element of that was extremely strong basis. And I think one of the best ways to explain what was going on in this scenario is just remembering that the specifications on these contracts are for expectation for price at expiration date. And there was so much risk in the marketplace with plant shutdowns, disease spread, that the risk between any given day and when that contract was going to expire was so great that it's really not surprising that that basis was that strong. Kind of a natural benefit of that was that it incentivized marketings before many of those fears came to fruition, and we saw those plant disruptions. I think another element in this as well is probably, given the rise in Cutout, which we'll discuss here momentarily, there was a bit of a tug of war between Cutout and futures in regard to cash live cattle prices. So now if we move into looking at cash prices, fed cattle prices relative to Cutout prices, I'll slow down a minute and try to explain this chart in a bit more detail. So on the left-hand side, we have the live cattle minus drop credit as a percentage of comprehensive Cutout. On the bottom axis, we have fed supply relative to operational processing capacity. So meaning, how much can we really get through a plant? Operational processing capacity would have dropped tremendously in April and May of this year, as we saw the challenges with social distancing, health protocols at plants even shutting down temporarily to combat disease spread. And if you notice, it's really all about leverage. As the fed supply relative to operating capacity is low, we see live price at a fairly high percentage of comprehensive Cutout. As that fed supply relative to processing capacity gets high, that percentage is going to come down. And it really just boils down to that equation we looked at the very beginning. If we don't have the operational capacity to turn those cattle into beef, it's tough to really put a high value on those animals. The other thing I think is important to note in this chart is that the red line was fit excluding the April through May ratios. So they had no influence on the trajectory of that line. But if you fit that line over the past 10 years and then project it into recent months, those prices really line up well within the margin of error. And that doesn't even account for the added operating cost with PPE and added health protocols. So let's look at Cutout. Study after study has found that beef demand, both at retail and the wholesale level, is very inelastic, meaning that a small change in quantity produced is going to generate a large change in price. And there's a study done by Lusk and others in 2001 that when they looked at the second quarter choice Cutout elasticity specifically, they found that a 1% change in choice product was roughly associated with a 5% increase in choice Cutout price. So if we use the 10% reduction in choice product in Q2 of 2020 versus Q2 of 2019, we could easily project those prices to be about $335 a hundredweight. In reality, the average Q2 choice price was $308. Obviously there's error in predictions, and some of that error in this situation was likely due to economic recessionary factors and just the challenges of shifting supply chains to more retail versus food service. But really, I think the summary in these last two charts is that as painful as it was for cattle producers, these price movements and magnitudes really were not unexpected. So what about that shift to retail? The two of these, the lower four lines here represent wholesale prices. We've got the round primal and the rib primal compared to the top two lines, which are weighted the weighted average ad price at retail. So the orange line and the gray line are retail prices. I think a couple things to take away from this chart is the extreme narrow spread between the round and rib primal as we were shifting from food service to retail. A lot of the beef sold at retail is ground beef, and that ground beef sold at retail comes from grinding parts of the round, grinding parts of the chuck. So we saw extreme demand for those primals in the initial stockpiling phases of COVID-19 and the stay-at-home orders. Meanwhile, as food service shut down and we were still shifting how to market more middle meats at retail rather than food service, having to shift that supply chain, the rib primal really did not increase as much relative to the round primal. And if we look at retail prices, I think it's important to note the lag. If you look at the peak in the wholesale prices versus the peak in retail prices, it ends up being several weeks. And really what that comes down to is two things. One is the purchasing contracts for that product are often weeks in advance, plus the time it takes to move that product from the packing plant to the retail shelf. There is some time there. And if you notice, we've seen all of these prices go back to near or even below year ago levels. So shifting more to the spread and cutout, we've seen exceptional grading rates. As I mentioned, the shift from food service to retail, really some diminished white tablecloth dining. That's really hurt the spread for prime product relative to other wholesale prices. But I think it's really encouraging to note how well branded product has performed from a cutout spread standpoint based on what it was versus the 5-year average. It's really held in quite well, and I think that speaks to how much branded product has penetrated the retail market. Any grocery store you walk down the meat aisle and it's tough to find product that doesn't have some sort of quality brand on it. So shifting away from what's happened to what's next, let's consider food service recovery. In the global financial crisis, it took about 7 quarters for food service to recover from its pre-crisis levels. In COVID-19, we're expecting that to be more closer to 8 to 10 quarters. So that puts us somewhere in 2022, maybe early 23, before we really get back to pre-COVID levels of dine-in type food service. Right now, we're in that easing out stage where quick service has recovered quite substantially. We're still seeing a little bit less than, we're down still a little bit over 20% in terms of full service. Note that that's sales in general, not necessarily dine-in. That includes a lot of curbside delivery, e-commerce, things of that nature. This is something I think we just need to keep in mind moving forward, is that we were forced as a society to really accelerate in how quickly we adopt change and incorporate new technologies. Once COVID-19 has passed, we have a vaccine, we'll likely go back somewhat to where things were before, but we won't go back all the way. The trend of change will continue, and we'll still be using some of these new technologies more than what we were before COVID. And I think as a beef industry, we need to keep this in mind because we need to be proactive and willing to adapt in this changing world where consumer preferences, supply chain practices, food safety, quality, convenience are going to be even more important than ever. Another big topic of discussion has been supply chain resiliency. And some of the talking points have been around globalization or even protectionism. How do we make more diverse and flexible supply chains? Do we replace labor with more automation? What about product traceability or just in time versus just in case? I think it's important to note that none of these considerations are free. And before we implement them, we really need to do a cost benefit analysis. I think some of these, doing looking at some of the research that's been done, doing some back of the napkin math, some of these seem like relative no-brainers, but some of them, are definitely risks. And one thing I'll say for the beef industry is we really need to work to maintain global trade because it's absolutely critical in value creation for U.S. beef. And global trade really is a two-way street. You can't implement protectionism and then expect to export. There's got to be some give and take on both sides. There's also been a lot of discussion around we need to expand packing capacity in order to make the supply chain more resilient. While there's certainly some merit to that, the thing is supply chain resiliency alone cannot fuel expansion. It has to be driven by economics and profitability. I show you this map, which was current in 2017, maybe a few updates to be made to it, but by and large, it remains valid today. The geographic concentration of the industry, with the little dots, orange dot or yellow dots being feedlots, big circles packing plants, and in the shaded area, different densities of cattle. Our industry has adapted in terms of scale and ownership and concentration, both geographically and in terms of ownership for a reason. And it's something we just need to keep in mind. So when we look at the opportunity for capacity expansion in the U.S. beef industry, it's useful to look at excess capacity relative to estimated profitability. You can see if you look at the last several years as excess slaughter capacity has diminished, we've seen profitability at the packing level, which from an economic standpoint could provide incentive to expand capacity. Another point I want to make in regards to the Holcomb fire versus COVID-19, they're often talked about as very similar events. And while the outcome from a market standpoint of those events was similar, the nature of those events is really different, and it has to do with the probability. So a freak accident, a fire at a single plant, that's an independent probability, meaning that a freak accident at one plant is not going to increase the likelihood of a freak accident at another plant. In that situation, more plants would likely add more supply chain resiliency. On the other hand, the COVID-19 slowdowns are interdependent in their occurrence. These plants are, our society, we were fighting the same disease, implementing the same added health protocols and social distancing, not to mention that we live in an integrated, interconnected society between communities, between plants. Just think about that map that we just looked at and the concentration of our industry in specific areas. It's pretty tough to argue that an outbreak at one plant would not, or a slowdown at one plant would not influence an outbreak or slowdown somewhere else within the supply chain. So how much added capacity do we need, or could the industry use? From 2002 to 2019, the average percentage of fed steer prices minus drop credit to comprehensive cutout was about 55%. In 2016, the average for that year was about 54%. So if the industry were to return to the leverage level of 2016, we'd need to add about 5,000 to 6,000 head of daily packing capacity. And so where could this additional capacity come from? Number one, it could come from technology at existing plants. It's highly likely that the increased production cost, both from labor and wages and potential regulatory oversight, are going to linger for some time and maybe even be permanent. So that really revitalizes the impetus to look at how technology can increase efficiency and reduce costs. While the big talk, the moonshot, if you will, is to have more robotic fabrication and cutting. Really, the near-term potential is probably more in actionable data collection and data monitoring to reduce bottlenecks within plants. And that could produce some meaningful increases in efficiency. Another potential would be smaller to medium-sized plants that really specialize in niche markets, talking 1,000 to 2,000 head daily capacity, that have really strong relationships across the entire supply chain with cattle feeders, with end product users, and really work to manage that supply chain closely and hope that the added value in the product they're producing can outweigh the potential inefficiencies with smaller plants to allow them to compete with the larger, more efficient plants. And it's not cheap. We estimate about $100 to $120 million investment per 1,000 head of capacity. And if we recall that cyclical nature of the beef industry, we have to have enough capital to survive a full cattle cycle. If we start building a plant today, by the time that plant's up and running, we're probably going to be in a tighter cattle supply situation compared to where we are at with peak cattle supplies in 2019 and early 2020. So something to keep in mind. Getting into the last slide here, just some parting thoughts from a big picture perspective. There's a book called The Black Swan that really became popular after the global financial crisis, and given the black swan nature of COVID-19, has become quite popular again. And the author of the book really makes several points about how history does not move in steady incremental crawls. It jumps and makes big, fast changes. And if we use US patents as a proxy for change, as an indicator, you can see that there are some peaks and valleys in the number of patents. If you kind of line those numbers up with wars and recessions, or maybe the space race, and particularly look at the late 90s with the tech boom, you can see some of those peaks and valleys. And we often talk about today how we're changing at a rate faster than ever. Well, this is some pretty good proof that that's true when we're registering about 600,000 new patents every year. And so with all this in mind, I think the beef industry has really capitalized on a lot of successes over the last couple decades. We've gained export market access. We've really improved genetics and increased meat product quality, but we can't simply rest on past successes. We have to really be focused on the consumer, being ready to innovate and be creative, because if history's making changes in jumps, we don't want to be be caught flat-footed. And in this industry, with the long production cycle, we need to be thinking 5 to 10 years out, because in reality, that's only a couple generations of beef cattle. So with that, I'll turn it back to Kara and open it up for questions.
Super. Thanks, Dustin. We do have a couple of questions we'll go ahead and start with. As you talk about innovations and technology and adapting, what are some things that specifically strike you as areas of focus at the ranch and feed yard level from a new technology and innovation perspective that will help put us in a better position to face these kind of challenges moving forward? Sure.
So the thing that immediately comes to mind for me is data management and documentation. It's one thing to collect data, which even at the cow-calf level, there's still challenges to that, given the geographic spread of those operations, the lack of connectivity in a pasture type setting. But really documenting what we do, that's going to be critical moving forward from a consumer standpoint. It may not even require major changes to production, but we need to prove from a sustainability standpoint, a supply chain standpoint, that we're doing things right. And then by collecting and managing that data, it really allows opportunities for the beef industry to improve as well. The obvious one is traceability in the case of a disease outbreak. We've seen 2 examples of that globally, both African swine fever and now COVID-19. So to think that that's not going to happen, we probably need to be a little more realistic than that. But even then, I think there's operational efficiencies that we can gain by better understanding what we're doing. You can't manage it if you can't measure it.
Very good. One more question related to some of your dialogue around branded programs versus spread on commodity products. As we move forward and some of the importance of branded programs or those niche programs you talked about become more and more important, do you foresee any issues or fewer places, I guess, for commodity beef to go within the marketplace?
I think that's an interesting point, and I think, yes, looking out 5 to 10 years, I think that's definitely a real possibility. And speaking to branded and niche type products, I think it goes beyond just product quality, but it goes to how it was produced, what's the documentation behind it. If you look at the long-term plans for most major food companies, whether that's a restaurant or a retailer, they have long-term goals regarding how and where they're going to source their product and how it's going to be produced. And I think there's a likelihood that in the future, it may just be a matter of exclusion. If you can't say that this product was produced in this way, it won't be sold here.
Very good. We've got time for one last question here, and this goes back to kind of the beginning of your conversation. And Dan hit on this a little bit too. As you talk about people fleeing to safer assets from an investment perspective, how do you suggest folks navigate the higher risk hedging landscape?
It's definitely something that often comes up, and I think really it's just about discipline and sticking to a plan regardless of how fast things might be moving around you. Really, if you look at cattle that were hedged going into this crisis, and with the collapse in futures and the basis scenario the way it was, those that were under a structured, disciplined risk management plan came out quite well. So I think one key is that make the plan, implement the plan before the times of crisis, and don't make knee-jerk reactions when things are moving really fast. Trust the decisions that you put in place prior to the crisis.
Okay. Well, Dustin, thank you so much. You've broken down a very complex topic for us today. We really appreciate you diving into some of those details and taking time to answer some of those questions.